Investing can feel like a complex puzzle. You want to grow your money. You hear about stocks and bonds. But picking individual companies is risky and takes a lot of time. This is where funds come into play. Exchange-traded funds, index funds, mutual funds are all tools that help you solve this problem. Each one is a type of basket. Instead of buying one single stock, you are buying a collection of many different stocks or bonds all at once. This simple act of bundling investments together is called diversification. It is a powerful way to reduce your risk because your money is not tied to the fate of just one company. While all three of these products offer diversification, they are not interchangeable. They are built differently. They are managed differently. Most importantly, they cost different amounts of money. Understanding these distinctions is crucial for anyone who wants to build wealth over the long term. We will carefully unpack these differences. It will use simple words and clear examples. We will focus first and foremost on the fees you pay. We will walk through how each one works, from how they are managed, to help you make a clear and confident choice. Think of it like choosing a car. A sedan, an SUV, and a truck can all get you from one place to another. But they have different fuel efficiencies, different handling, and different costs to maintain. One is not universally better than the others, but one is likely better for your specific needs. Similarly, ETFs, index funds, and mutual funds are all vehicles for your investment journey. Your job is to understand their features. This knowledge will empower you to select the one that best aligns with your financial goals, your budget, and your personal style of investing, putting you in the driver's seat of your financial future. This guide is designed to be calm and practical. It will not use confusing jargon or complicated charts. The goal is to give you a reality check. We will explore the pros and cons of each option, showing you exactly how costs can eat into your returns over many years. By the end, you will have a solid foundation. You will understand why fees are paramount. You will know how to buy and sell each product. And you will be able to identify which of these powerful investment tools is the clear winner for your own portfolio, helping you stop guessing and start investing with purpose. To understand these funds, we must first look at how they are managed. There are two main styles: active management, passive management. This difference is the core of what separates many mutual funds from their index fund and ETF counterparts. Active management is a hands-on approach. A traditional mutual fund often employs a team of professional fund managers and analysts. Their job is to research companies, analyze market trends, and make strategic decisions to buy and sell investments. Their stated goal is to beat the market, meaning they aim to achieve higher returns than a standard market benchmark, such as the S&P 500 index. This active style of management requires significant resources. It involves salaries for the manager's costs for research and data-frequent trading commissions. All of these expenses are passed down to you, the investor, in the form of higher fees. The central promise of an actively managed mutual fund is that the manager's expertise will generate returns that are high enough to justify these extra costs. You are essentially paying for a skilled pilot who claims they can navigate the market's turbulence better than anyone else and deliver you to your destination with more wealth than if you had simply gone along with the flow of the market. In stark contrast, passive management is a hands-off strategy. This is the philosophy that powers almost all index funds and the vast majority of ETFs. Instead of trying to beat the market, a passive fund simply aims to match the performance of a specific market index. For example, an S&P 500 index fund does not have a manager picking what they think are the best 500 stocks. It simply buys and holds all 500 stocks listed in the S&P 500 index, in the same proportions as the index itself. The fund's goal is to mirror the market, not to outsmart it. This passive approach is far simpler and, therefore, much cheaper to operate. There is no need for a large team of highly paid analysts or frequent speculative trading. The fund's computer-driven process is straightforward. Own what the index owns. Because the operational costs are so low, the fees charged to investors are also very low. The surprising reality, confirmed by decades of data, is that most active managers fail to consistently beat their benchmark index after their higher fees are taken into account. This has made the low-cost, simple, and effective strategy of passive investing incredibly popular among savvy investors. Of all the differences between these investment types, none is more important than cost. The fees you pay might seem small on paper, often expressed as a percentage called the expense ratio. An active mutual fund might charge 1% per year. A passive index fund might charge just 0.05%. An ETF might charge just 0.05%. You might think a difference of less than 1% is trivial. This is a costly mistake. Over a long investment horizon of 20, 30, 40, this small difference in fees compounds into a massive difference in your final account balance. Fees are the single most reliable predictor of future investment returns. Let's use a simple, real-world example to see this in action. Imagine you invest $10,000. Let's assume the market earns an average of 7% per year before fees. With an active mutual fund charging a 1% expense ratio, your net return is only 6% per year. After 30 years, your initial $10,000 would grow to about $57,435. Now, consider the same scenario but with a low-cost index fund that charges just 0.05%. Now consider the same scenario but with an ETF that charges just 0.05%. Your net return is 6.95% per year. After the same 30 years, your $10,000 would grow to approximately $75,377. That seemingly tiny fee difference cost you nearly $18,000, or about a quarter of your potential earnings. This destructive power of fees is relentless. It works against you every single day, year after year, silently eroding your wealth. High fees act like a constant headwind, slowing your financial progress. Low fees, on the other hand, act like a tailwind, helping your investments grow closer to their full potential. Beyond costs and management style, these three investment vehicles differ significantly in how you buy and sell them. This affects their convenience and flexibility. ETFs, or exchange-traded funds, trade just like individual stocks. You can buy or sell them at any point during the day while the market is open. Their prices fluctuate throughout the trading session based on supply and demand. This intraday trading allows you to react quickly to market news. It also enables you to use more advanced trading strategies. For example, setting a specific price at which you want to buy or sell. A limit order. Visual clock comparison. Left, multiple ticks labeled ETF trading, all day. Right, single tick at end of day labeled mutual fund trading, end of day only. Mutual funds, including index mutual funds, operate on a different schedule. They do not trade throughout the day. Instead, all buy and sell orders placed during the day are bundled together and executed at a single price after the market closes. That price is called the net asset value, calculated once per day from closing prices. So you don't know the exact price when you place your order. That makes mutual funds less suitable for active traders and more aligned with investors who prefer a set-it-and-forget-it approach. Another practical difference is how you purchase shares. With ETFs, you can typically buy as little as one share. If an ETF share costs $150, you can start investing with that amount plus any commission. Many brokerages have eliminated ETF commissions, making them more accessible. You do need a brokerage account to trade ETFs. Some brokers offer fractional ETF shares, allowing investments of very small amounts. For example, $5. For example, $10. Taxes are another area where these funds can show significant differences, particularly if you are investing in a regular, taxable brokerage account rather than a retirement account like a 401k or an IRA. In simple terms, ETFs are often more tax efficient than mutual funds. This advantage comes from the unique way ETFs are created and redeemed. When large investors want to sell their ETF shares, the ETF provider can give them a bundle of the underlying stocks directly. This in-kind transfer is not a sale and therefore does not trigger a taxable event, which helps keep the fund's internal capital gains low. This process minimizes the chances that the fund will have to distribute capital gains to its shareholders. A capital gain occurs when a fund sells an investment for a profit. By law, funds must pass these gains on to their investors at the end of the year, who then have to pay taxes on them. Because ETFs can avoid selling securities to meet redemptions, they tend to generate fewer of these taxable distributions. This means you have more control over when you pay taxes. Typically, only when you decide to sell your own ETF shares for a profit. This tax deferral can be a powerful advantage over many years. Traditional, actively managed mutual funds are often the least tax-efficient of the group. The active manager is constantly buying and selling securities in an attempt to beat the market. This frequent trading can generate a lot of short-term and long-term capital gains within the fund. After reviewing the core differences, management cost trading taxes, we can draw some clear conclusions. The choice between an ETF, an index fund, a mutual fund, ultimately depends on your personal investment style and priorities. There is no single perfect product for everyone. But for most people seeking low costs and flexibility, one option clearly stands out. The evidence strongly suggests that for the majority of long-term investors, a low-cost, broad market ETF is the clear winner. It combines the best features of the other vehicles into one superior package. Rock-bottom fees of passive indexing, tax efficiency that protects returns, trading flexibility of a stock, buy and sell throughout the day. Start with a single share, small amount. Avoid surprise tax bills that plague mutual funds. Transparent, accessible, incredibly cheap hands-on investor who wants control. Hands-off investor who wants the most efficient tool. ETF is an outstanding choice, difficult to beat on nearly every metric. However, other options have their place. A low-cost index mutual fund is an excellent close runner-up. Primary advantage: convenience for automated investing. Automatic paycheck contributions. Set it and forget it. Great for beginners building a retirement nest egg. Choose one with very low fees. Traditional high-cost active mutual fund is hard to recommend. You're betting the manager will outperform by more than their fees. Decades of research show this is a losing bet for most funds. A few star managers exist, but they're nearly impossible to find in advance. Most investors should avoid high costs and unpredictable active funds and stick with passive ETFs and index funds. Your future self will thank you.